Today we are going to cover a question from December Financial Reporting 2019. So we are going to cover the question 2, scenario 2 of Runner Co and Joker Co. Now let me scroll down there. This is the question scenario 2. Let's go to the required. Required A, prepare the consolidated statement of financial position for Runner Co as at 31 March 20X5. 16 marks. So we are going to do this question for 16 marks. Now, let's go to the scenario. On 1 April 20X4, Runner Co acquired 80% of Joker Co's equity shares when the retained earnings of Joker Co were 19,500 million. The consideration consisted of 42.5 million paid on 1 April 20X4 and a further cash payment of 21 million deferred until 1 April 20X5. No accounting entries have been made in respect of the deferred cash payment. Runner Co has a cost of capital of 8%. The appropriate discount rate is 0.926. The draft summarized statements of financial position of the two companies as of 31 March 20X5 are shown below. You've got assets, non-current assets, property, plant and equipment, investments, current assets, inventory, trade receivables, bank, equity shares of $1, retained earnings, current liabilities, trade payables. Then we are given the notes there. Runner Co's policy is to value the non-controlling interest at fair value at the date of acquisition. The fair value of the non-controlling interest in Joker Co on 1 April 20X4 was estimated at 13 million. The fair value of Joker Co's other assets, liabilities and contingent liabilities as at 1 April 20X4 were equal to their carrying amount, with the exception of a specialized piece of plant which had a fair value of 10 million in excess of its carrying amount. This plant had a 10-year remaining useful life on 1 April 20X4. In December 20X4, Joker Co sold goods to Runner Co for 6.4 million. We're going to use this figure when we're doing the consolidated statement of profit or loss, but in this instance we are only asked the consolidated statement of financial position. So the we will not be using the 6.4. Earning a gross margin of 15% on the sale. Runner Co still had 4.8 million of these goods in its inventories at 31 March 20X5. Joker Co still had the full invoice value of 6.4 in its trade receivables at 31 March 20X5. However, Runner Co's payables only showed 3.4 million as it made a payment of 3 million on 31 March 20X4. What happened here? Runner Co made a payment, but the payment did not reach Joker Co. So what it means, there is a cash in transit of 3 million that needs to be added into the bank. That's all the information that we have here. So let's go step by step. The first step is to do our workings. Consolidated statement of financial position has got standard workings. The first working is the group structure, whereby here Runner Co has 80%, then the NCI has got 20. So we'll skip that working, then we'll come to net assets of Joker Co. We want the net assets at acquisition and also at reporting. We've got the share capital. as always, the share capital of Joker.com is 25,000. We've got retained earnings. We're given that retained earnings at acquisition were 19.5 million, so it's 19,500 in thousands. Then retained earnings at the reporting or at the year end is 28,600, like that. Then we've got FVA on plant. We are told that the plant FVA on plant is 10 million, so we say 10,000 in thousands. At acquisition and also is 10,000 at reporting. Then we have got excess depreciation. We are told that the asset had a 10-year life at acquisition, so we can divide by 10 here. That's 1,000. Let's go again to note number 2. Joker Co sold goods to the parent Runner Co for 6.4 million. As I said, we will not be using this figure. Runner Co still has got 4.8 of the inventory. So now we have got PAP on closing inventory of the parent. So we'll say 4,800, which is 4.8 million, multiply by 15%. This time we will not be saying 15 over 115 as this is a margin. So we'll say 4,800 multiplied by 15%, like that. We get that figure. Then at this point we'll have to sum everything. Let me copy the formatting. Then we'll sum here as well. Then let's go to working number 2. Working number 2, which is goodwill. We'll say consideration. How much did the parent Runner Co pay? Parent Runner Co paid 42,500 cash. So we have got a cash element of 42,500. We also have got a deferred payment. Deferred payment of 21,000. So 21,000 paid at the end of the year multiplied by the discount factor that we are given here, like that. So we'll say 21,000 multiplied by 0.926. That's the figure that's the present value of that 21,000 at the beginning of the year. But we have to show the liability of 21,000 at the end of the year, as this 21,000 will all be paid at the end of the year. So the difference between 21,000 and 19,446 is the unwinding of the discount. We'll come back to that. Then we have NCI. We are told the NCI value at fair value is 13 million, so it's 13,000 in thousands. Then now we have to less net assets at acquisition. The net assets at acquisition, we have them here. We'll list them like that. Then we now have to calculate our goodwill. It's 2446 our goodwill. Let's continue with our working. Now working 3, which is the NCI. NCI, we've got opening balance at acquisition is still 13,000. Then we need to give share of post-acquisition profit. So I'll say share of profit. How much was the profit? We'll say 61,000. This figure of net assets at reporting less 54,500 at acquisition, all multiplied by the percentage of the NCI. The parent has got 20, so the NCI, parent has 80, so the NCI has 20%. So simply say 61,880 minus 54,500, all multiplied by 20%. We get that figure, then we sum up to get our NCI figure. Then now let's have our group retained earnings. We've got opening balance of the parent. How much are retained earnings of the parent in the statement of financial position is 286,600. We give them their share. Let's copy this. We give them their share of profit, which is 80%. So we'll simply say 61,880 minus 54,500 multiplied by 80%. That's the share for the parent. Remember, we have got unwinding of the discount. Unwinding the discount on the deferred payment, we say at the end of the year the deferred payment will be 21,000 less the present value at acquisition 19,446. The difference we said is the unwinding of the discount, 19,446, like that. We get that figure, then we need to sum up that. We get that as the group retained earnings. I think we have dealt with everything that is on this statement now. Then we need to go on and prepare our statement of financial position. We have got goodwill. Before we forget, our goodwill, we take it in the goodwill working here is 2446. Then we go to our assets. We have got PPE. Our PPE for the parent is 55,800 plus the subsidiary 44,700 plus 10,000 fair value less excess depreciation of 1,000. Then we'll say 455,800 plus 44,700 plus 10,000 less 1,000. We get that. Then under investments, we've got 55,000, but we need to less the cash element of 42,500 from that figure there. So simply say 55,000 less 42,500, like that. We get that. We can add that as the non-current assets. Then for current assets, we've got inventory. Remember, on inventory we've got PAP, so we've got 22,000 plus 16,000 less 720 PAP. So we'll simply say 22,000 plus 16,000 less 720 PAP. We get that. Then we have got receivables. Receivables, we have got 35,300 plus 9,000 less, let's go to the last note, less 6.4 intra-group, 6,400, like that. So we'll simply say 35,300 plus 9,000 less 6,400. We get that. Then we have got bank now. Bank also, we've got this cash in transit of 3 million. So we'll say bank, we've got 2,800 plus 1,500 plus 3,000. That is cash in transit. 2,800 plus 1,500 plus 3,000 cash in transit. We get that figure. Then when we sum that, we get that. Then we sum non-current assets plus current assets. We get this figure as total assets. Then let's move to equity and liabilities. We have got share capital. We take the share capital of the parent only, 202,500. We've got retained earnings. We take the retained earnings of the parent, we have them here. We have got NCI. We have the NCI figure here. Then we sum that. Then we have got non-current liabilities. We have the deferred payment. We say the deferred payment at the end of the year, it will be 21. it will be 21,000. Then we have got trade payables. Trade payables, we have got 81,800 plus 17,600 minus this 3,400, 3.4 million. Then we'll say 81,800 plus 17,600 less 3,400. We get that. Apologies here. The deferred payment is no longer a non-current liability, is now a current liability, as it will be paid in the following day. Today is 31 March 20x5. It will be paid on 1 April 20x5. So it becomes a current liability. Then we sum that. Then if we sum the equity plus the liabilities, we get the total equity and liabilities. This is what was expected of us in September, December 2019 to get ourselves these 16 marks here. Try to read the whole scenario and try to follow what I was doing here. You will be able to do the same in your examination. Thanks for watching, and do not forget to subscribe to my channel.